All right, everybody. My name is Miles Pitcher. I'm the owner of Superior Lending. Thanks for taking a few minutes to join me on this. I guess it's a Zoom call. I don't know what the difference between a webinar and a Zoom call is, but thanks for joining me. By the way, I am recording this. So just so you guys know, use the chat if you want for questions. We'll have time at the end also for any questions you guys have on this. But I had two things for you. Every year I do some corporate ski passes to Sundance, and I make those available to people. So if there's a day you guys would like to go up skiing, snowboarding up at Sundance, use the passes, just shoot me a text, let me know. Those are available. I have two of them. I can get a couple more if you have a bigger group. So that's number one. Number two, we are super excited. We haven't announced this out to anyone yet, but this is just super exciting for us in that there is a show on CNBC called Financing the American Dream. And it goes around to different cities across the United States and highlights the cities, the businesses, agents, and it's hosted by a local loan officer. So I have auditioned and been selected to represent Utah and the Financing the American Dream show. So we get to film this in January, and our episodes will start sometime in February. So watch for that. All righty, let's get into this. Let's get into why you guys are here and what we have going on. So this is really cool. This is a loan product that has been around for a long time. It's been around 15 years. It was started in 2005. I'm of the belief that I will never put a client into a product that I haven't done myself and I don't know very well the ins and outs. I have done this loan product on my personal home. I did it several months ago. It's been phenomenal. And since then, we continue to have more and more clients join in and love to do this product. So let's walk through it. I'm going to give you kind of the structure of it, and then we'll actually go through an example and show you the application of it, how powerful it is. So let's make sure I can advance here. All right. So a few questions, a few things to think about. So I imagine that many of you have rainy day funds. Those are sitting probably in a checking account. I was the same way as a small business owner. I always had my reserves setting aside. Why don't we use those to pay down our mortgages, right? Why don't we dump those in? The answer is then those funds are no longer available to us. Those funds are the only way to access those is to do a cash out refinance, sell my home, or put a HELOC on the property. So we just tend to leave those sitting in our checking account. Another question for you is, how long does it normally take to pay down half the balance on your mortgage if you're just making minimum payments on a 30-year mortgage? Do you realize that it takes till like year 23 and a half before you've paid down half your balance on your mortgage? It's kind of ridiculous. And then also think about this. What's more important, the interest rate on your mortgage or how much you're actually paying in mortgage interest? And the answer to that is obviously the mortgage, how much you pay in mortgage interest. So this loan product is a pretty cool product because it's really designed to reduce the total interest that our clients pay on their mortgage. And by paying less on mortgage interest, man, they're freed up to do other things, investments, retirement, reduce other debt, investment properties. It's pretty cool. All right, let's keep going here. All right. So our 30-year mortgage has been around since 1933, and our industry thinks that they're innovative, but really not so much. We've been doing this since 1933. And the problem that we have on our 30-year mortgages are great. I make a living off of doing those, but there are some flaws with it. Number one, the amount of payments in the first years that go towards interest versus principal is really interest heavy. And as you guys know, most of our clients are not staying in their homes longer than 7, 8 years. So the majority of what they pay is going to interest. The other problem on the structure of a 30-year mortgage is that there's no liquidity. The money goes in and it's locked away. Again, as mentioned, the only way to access those funds is to do a refinance or to sell the home or do something else like that. Okay. So this new and I say new, but it's new only in the sense that we've just started doing it, is that it provides our clients flexibility, liquidity, and it significantly reduces the years on their mortgage and saves them tons of interest. We are on average seeing people reduce their mortgage anywhere from 10 to 15% of their loan balance every single year. Pretty incredible. Yeah. All right. So what is it? It's an offset mortgage. We use the term or the title of an all-in-one loan. Okay. Not to be confused with a one-time close, which is a construction loan and a 30-year mortgage combined. This is different. We call it an all-in-one loan. So let me walk you through how this works and the structure of it. Okay. So the purpose of it is to help reduce mortgage interest, pay off their debt and their homes more rapidly, more comfortably. It's powerful in what it can do for some of our clients and their financial positions, their financial pictures. So this has been around forever, not forever. It's been used in Europe, Canada. It's been used in our commercial lending. This loan actually was discovered and started in the US in 2005 for residential mortgages. So it's been around for 15 years. The company that started it went to Australia, heard about this product and said, this is brilliant. Why aren't we doing it? They came back and started it in 2005. So it's been around for a long time and they have a long history of it. I want to reiterate or tell you guys that on this loan, since this company has been doing it, they have had 0 defaults, 0 foreclosures, 0 late payments in 15 years on this loan product, which is incredible. All right, keep going here. Okay, typically, let me get a pointer out here. Typically, we get our money that we receive and we just park it in the bank, maybe a savings account. And I'm sure you guys are getting phenomenal returns on your savings accounts right now. And then we have our mortgages sitting over on the side. This loan, yeah, our money in the bank's making a super low interest amount. And then the idea is if we put it over and reduce our mortgage balance, it helps reduce down how much we're paying in interest. So we'll use this example throughout our numbers today, but somebody owes 800,000. They have 100,000 saved. They can move that over and reduce down the balance and pay interest on 700,000. So let me show you a little more detail on how this works and explain it a little bit better. So what this does is it combines the power of a home equity line of credit, which you're all familiar with a checking account. Okay. It puts these two together as a tool and adds in some extra features. This is not your normal home equity line of credit. We all know what those are and know how those typically work. This has some extra features to it that make it better and make it awesome. So this checking account is at a a federally insured bank, FDIC insured. It's a checking account that has all the features, ATM cards, checks, bill pay, all the normal things. You can wire funds in and out. And then what we use is and this can be done on a purchase or refi, is we replace the balance of your mortgage and pay it off and put this home equity line of credit in place. There is a sweep account a sweep between the HELOC and your checking account. And this is one of the features that makes this pretty awesome. So as your deposits come into the bank, into your checking account, every single night at midnight, it'll sweep your checking account balance over and pay down your mortgage. Sometimes these are sweep accounts are also referred to as zero balance because it always takes your checking account down to zero every single night. What has that done? It has reduced your loan balance down and has reduced down what your monthly interest is. Because on this loan product, the amount of interest you pay is calculated on the daily balance, not on the way your normal 30-year mortgage works, okay? It's on the daily balance. So the longer that you can have your deposits sit in the HELOC, reducing your principal balance, the more you're going to save in interest, okay? At the same time, there are withdrawals that can come out of that checking account just as you get around to paying your bills. These bills, normal monthly household bills, utilities, credit cards, whatever it is, the money will sweep back from the HELOC to the checking account and allow you to pay those bills, okay? So just as this says, money not spent from the account is always at work, keeping the daily principal balance lower, which reduces the amount of interest the borrower is charged overall. I'll show you guys more how this works, but again, let me just restate kind of how it works. You have your direct deposits that come in, any commissions you have come in, any income that you have come into your checking account, is that checking account is tied to the home equity line of credit, it automatically sweeps over, okay? Reduces your mortgage balance. So here's the benefits of it. Number one, we've seen it save hundreds of thousands of interest for our clients, not only tens of thousands. I shared with you that this is building equity faster than a normal traditional loan. Our clients are reducing their loan balances 10 to 15% per year. We're seeing clients pay off their mortgages anywhere from, we've seen it from just a couple of years up to 11 years or so, okay? The cool thing about this is that just like a home equity line of credit, you have access to that equity for 30 years. And I'll show this to you. This is something different than your normal credit union HELOC, where they only give you 10 years and then they freeze it. In this product, you have access to this equity for 30 years. If needed, you can pay interest only. All right. So yeah, you can purchase and refi. You can do as little as a 10% down on this for your purchases. Loan balance has to be under 850,000 if you want to do 10% down. You'll notice that these loan balances we're talking about are high. There are no jumbo limits on this loan product since it's not Freddie Mac or Fannie Mae. We are using this a lot with jumbo clients. So we can go all the way up to $2 million on loan amounts. That requires 20% down at that point. But if you're doing 10% down, you can do a loan amount up to 850,000. You do have to, these words over here, LPMI or BPMI, that refers to the mortgage insurance. Anytime you have less than 20% down, we have to buy out the mortgage insurance. So there's a one-time fee to do that if you're putting less than 20% down. My good friend Kathy had some clients who we helped do this product. We bought out the mortgage insurance on that product for them. Works out pretty awesome. We can do this on primary residences. We can do it on second homes and investment properties. Investment properties can only go up to 75% loan to value. So 25% equity or 25% down. You can have 2 of these at a time. I did mine on my primary residence. I'm doing another one right now on a St. George second home that I have. Once you close, 20 to 30 days after that, you get all the access to the checking account things, debit cards. You can wire in, wire out. You get normal checks. You can do mobile banking deposits. It's a normal checking account. It's pretty awesome. So this helps to show this a little bit better. So this top blue line represents your line of credit, the maximum credit you have. So if you bought a home for $1 million, you put 20% down, this would represent 800,000 credit limit available to you. Once you hit year 10, your credit limit will reduce 1/20th per year till you reach year 30 when it reaches 0. Okay. So just the same, yeah, your credit limit remains unchanged for 10 years, and then it can reduce by a little bit every single month after year 10. So you can see that it would reduce by 3,333. That's your credit limit, how much you can borrow. Because remember, you can put money in, draw money out on this through the whole period. So here's an example. Maybe for the first few years, you're saving, you're putting money in, and then you need to pull some money out for a home remodel. Then you do keep paying it down, medical emergency, college tuition. Maybe you retire and you decide to travel the world. You can see how this is fully accessible to you. So there are, and I'm still covering the structure. I think you guys will show you here in a minute some examples, but there's an option here for a 1-month adjustable on this, a 3-year fixed or a 5-year fixed. After the fixed period, it does go variable. It is based on the 1-month LIBOR right now, which is super crazy low. So it has the LIBOR, whatever that's at, and then a margin on top of that. There is a lifetime cap on it, and there's a floor on it. Right now, if you took the margin and added LIBOR to it, you would be below the floor. So most of our clients are going in at 3.75. The 5-year fixed on a primary residence happens to be the best product right now. That's what we're putting everybody into. So they're locked in for 5 years at 3.75. And again, remember that this product, some of you are probably thinking, well, interest rates are in the 2s right now. Yes, they are, but I'll show you some examples here in a second where the interest rate does not matter as much as how much you pay in mortgage interest. So I'll show that to you here in a second. Okay. So we know in our traditional mortgages that we do right now, very little goes to principal every single month. It drops down and the balance stays flat till we make our next payment. In an offset or an all-in-one, we make a monthly deposit, then you have some monthly expenses that come out, and then you have another deposit that comes in. It kind of seesaws downward. Who is this really solid for? Salary employees, commissioned earners, self-employed. Our self-employed borrowers are loving this because they have reserves, they have rainy day funds that are just sitting there. This allows them to put those funds to work in reducing their mortgage, saving them thousands in mortgage interest, but it gives them the liquidity to be able to pull that out. Realtors are loving this, right? You have a couple of great months with commissions coming in, pay down your mortgage with it. And then maybe you have a slow month. This is great. It allows you to still draw those funds back out. Who is it not for? This is not for the clients that really will be drawing out, well, who max out their credit cards. So yeah, we look at our clients when we do this. If they are not disciplined, we won't put this in there. Those are the people who need the structured 30-year or 15-year mortgage. But for those who fit into these categories, cash flow positive borrowers, this is such a great thing for them. Jumbo loans, so like I mentioned, this is great for them. Okay, let me switch screens and show you guys this. Okay. So there is a website that we have. I will email out to you the link to this website. It is aioloan.net, and it is a simulator. This is what the start screen looks like. This is pretty cool. We'll walk through it. So you click on get started, and then we're going to throw in some numbers. We're going to say somebody's buying $1 million home. I know that's up there, but that's really where a lot of clients are that we see doing this. We're going to compare it against a 30-year mortgage. Both scenarios, the client's going to have $200,000 or 20% down payment. Right now, interest rates on these jumbos like this will be 3.25 to 3.375. So principal and interest on that 30-year mortgage would be $34.82. Okay. If you were a client that was putting in $100 extra month or whatever, you could add it in right there and making extra payments. If there was a second mortgage tied with it, you could add it in right there. Then you just continue. Now, this client that I'm thinking of, they have a gross of making, it's usually around $14,000 a month. But after taxes, I think they're around $10,000 a month. We'll use easy numbers. So we put in what their monthly is. If you know annually, you can just click that. Now we're going to look at their expenses. And you can do this as a percentage or you can itemize it. It's easy just to do the percentage. So this client that we are dealing with had, so you can see that they have $10,000 in deposits every month. The mortgage on the 30-year would take out $3,400. And then their monthly expenses would usually leave them about 40% left over. So they had about $2,500 in utility bills, cell phone bills, gas, those items. They had about $4,000 a month left over. So this is the comparison. This is where this is awesome. So on the right-hand side, here we have our 30-year mortgage that we're comparing. We have the all-in-one on the left side. It's if just minimum payments are made, that mortgage will take 30 years to pay off, 1.2 million in payments. This one will take 13.8 years to pay off, and it'll save them around 107,000. And there's even some other good news in this, and I'll show it to you in a second. These payments are the averages over the life of both loans, but here's a few cool things. On the 30-year mortgage, they're reducing their principal down at 3.3% per year. On this one, this guy's reducing it down 7% a year. We ran this one, you see this right here, interest rate used, we ran this at 6%. We're doing this as a worst case scenario. Break-even rate, the rate would have to move up to 7% for it to be equal to the 30-year mortgage. That's pretty cool. So down here, this gives you kind of a chart that shows in the green how quick the all-in-one gets paid off. The gray is the 30-year, and the dark blue is the credit limit. And you can see how that diminishes. Okay, down here in the assumption, when you guys start playing with this, this is cool. Right now in the bottom right-hand corner, you can see that we have a real conservative interest rate at 6%. If I change this to stable rates at current level, it put it at 3.9%. Let me scroll back up to the top and show you. We just paid that loan off over a year faster. And look how much interest we just saved that client, $252,000. Okay. This is assuming that the client has $10,000 a month coming in and that 40% of that is being left in the checking account, being saved every month. Does he still have access to those funds? Absolutely. He sure does. Let me show you. If you come down on this pay down estimation, this gives you, again, month by month, showing the principal moving down on the 30-year and the all-in-one. I want to come down to, I'm scrolling down to, I'm in year 12, month 144, or month 145, the all-in-one is paid off. He's paid off the whole mortgage. The 30-year mortgage still has $566,000 left in the loan balance on this. Okay. Here's a little illustration again, how it shows how the balances every single month are moving down. So let me close this out. So the cool thing on this simulator, what I like to do with clients or people who are interested is to do it with them on the phone, set it up for them, and then you can send them the link. And when you click save up here, it gives you a code and you can write that code down. You copy it. And then when you come back to the home screen on getting started, you can put that code in and pull up the scenario and play with it. So our clients, I love to help set them up on this, and then they can go through and play with the numbers and adjust them as they start looking closely at what their expenses are and see if it makes sense. All right, let me hop back to a different screen share here. Okay. All right. So a few questions that typically come up. How many can you have? You can have 2 of them. Okay. Is there a prepayment penalty? No, there is not. What makes this better than just going out and doing a first position HELOC? So number one, the interest rates on these are lower than your standard HELOCs that you'll get at local banks. You can find some with introductory rates, but most of them will settle in anywhere 5.5%, 6%, 7%. So the rates are lower. The other part of this is it has features that are tied in, such as the automatic sweep between the checking account and the home equity line. You do have to use the banks and be set up with the banks that are the lenders on these. Currently, right now, it's North Point Bank, Bank of Indiana. My personal all-in-one is with North Point Bank, and they have been awesome to work with. They give you assigned personal bankers that if you ever have any questions or need any help on anything, they totally jump all over it. I've been using the mobile check deposit feature with them, and it works slick. The other feature why this is better than a normal HELOC is that, again, we've shared with you that it lasts for 30 years, whereas the local HELOCs will freeze after 10 years, and then you have another 20 years where you have to just repay back the balance. Again, people ask, how long has this been around? It's been around since 2005. The concern that comes up a lot is, hey, during 08, 09, home equity lines were frozen. None of these accounts that went through 2008, 2009 were frozen. They stayed open. People still had access to their equity. It really, I mean, what a great test, right? On these products to have gone through the Great Recession. COVID hit. Did they freeze them then? No, they did not. These are a great tool. So big picture wise, just think about this. Think about arming this with some of your clients who really have that desire to build a portfolio of investment properties. For example, I've had a great year. I had reserves saved up. I put this in place and I was able to immediately pay off my mortgage. I still have that all-in-one there. So my home appraised for 700,000. I did 80%. I have a $525,000 line of credit. When I find a great deal on an investment property now, I will go write a check and buy it in cash. I'll draw it right out of my all-in-one account. Then if I want to, I can take my time and put a refinance on that new investment property and replenish or pay back my all-in-one loan. Or if I want to play it conservative, I'll just leave that property free and clear, collect the rents, and use that to, again, pay back down my all-in-one loan. And I'll just rinse and repeat that process over and over. My plan is to have 2 of these that are paid off so that I have a great tool to be able to use my equity as a tool in acquiring additional properties. So it's pretty awesome. Way cool. Okay. I have thrown out a ton of stuff and I'm sure I didn't explain everything really, really well. So I am, let's see, and I haven't been watching the chat, but if there is chat, there we go. Okay. Somebody asked residential only or what about commercial? So great question, Bill. Let me answer that. So this is residential only, but think about this. It works on fourplexes, right? Somebody is going to go buy a $900,000 or $1 million fourplex. You can do it on that. That is an awesome way to do this. If you did it as investment property, you'd still have to do 25% down. But we cannot do it on commercial, but 1 to 4 units. So great question. All right, I'm ready for other questions. Hit me with what you guys got. I didn't explain things that well. I know some of you guys have questions. Come on. And I'm happy to answer these offline also. But yeah, hit me with some additional questions.
I got a question.
Okay.
So how do you recognize the person that this does not fit?
Sorry, TJ, can you say that one more time? I had a big truck drive by right when you asked it.
No worries. I'm asking about how you find the person that this just does not work for so that you can make sure that they don't get buried by this.
Yeah, totally. That's a great question. And that is something that we're super careful of. And I think you guys can sense those people. They typically are the people who have, and as a realtor, you may not discover this, but for us, the minute we see a credit report and see people have their credit cards all maxed out, that tells me that they're not a great option.
Gotcha.
It's also the people who sometimes I look at and they have a whole bunch, they're just zero balance in all their accounts, right? Maybe they had a 401k account and they liquidated it, right? They just continue to burn all their assets.
Gotcha.
So they're just highly leveraged people. And I would be doing a huge disservice putting someone like that into something like this loan product. Those are the people that need the forced savings plan and the discipline of a 30-year or 15-year mortgage.
Right.
So, as an agent, I would tell you, number one, anyone going into the jumbo range, they need to be aware of this product because these are usually people who are disciplined. They're making great money. Jumbo products are fabulous for this. I also need to mention, and maybe this is one of the best qualifiers, is that people who do this product need to show 10% of the loan amount in reserves. That can be a retirement account or other assets that they have. But maybe that's the best way for you guys as agents to say, hey, do you guys have any reserves, retirement accounts, things like that? If they don't, we know where they need to go at that point.
Gotcha. Now, how quickly can you turn one of these loans, like from let's do this to we're finished?
Yep. So on refinances, we're about 45 days. On purchases, they get prioritized. We're getting them done under 30 days.
Nice.
Yep. Yep.
Nice.
They're pretty cool. Underwriting guidelines are very similar to a Freddie Fannie loan, but there are just a few nuances. Like I mentioned, the reserves being 10% of the loan amount.
Do you find that this would fit kind of those high-powered jobs that come out of school with like stupid, crazy debt, like doctors, physicians, lawyers, like they just haven't earned their income yet, but they have a job that says, or they have a letter that says, hey, we're going to make this much money this year, but they have 300 grand in debt.
Yeah, I would totally put someone in here as long as they show that they have the discipline of a budget or they're savers of some sort. So yeah, I would, those people like that are going to continue to have better and better earning power as they go. Yeah, huge fan of doing it for those guys. And many of those people are the type of clients that recognize the power of this, in that, holy cow, we got a tool now where we can utilize the equity in this home in doing things in the future. Not only does it save us now in mortgage interest, but it frees up money that you can go pay off their $300,000 of student loans or whatever they are walking out the door with.
Right. No, that's interesting. I really appreciate your info, man. I know we just like slammed this out a week ago for a minute, but I wanted to hear more.
Awesome. Great. All right. Other questions. Thank you for those questions, TJ.
Mm-hmm.
Yeah. Anybody else?
What are the costs like on this loan? Is it comparable to a regular refinance, or is it more expensive or less expensive?
Sorry, can you say it a little louder? My speakers are weak sauce today.
Just wondering about the cost of the loan. Is it comparable with a regular loan, a 30-year mortgage?
Yeah, that's a great question. So closing cost wise, most of my 30-year mortgages I structure have no origination charges on these. On these loans, there is always going to be a little bit of an origination charge on the front. We're talking 0.5% up to 1.5%, depending on loan size and credit score of the client. And by the way, credit scores have to be up over 700 on these clients. So another note. Underwriting fee is there, appraisal is there, processing fee is there, all the title fees are there, just same title fees as normal. What is not there on these loans, and I'm glad you asked the question, is that all the escrows are not included in the closing costs. Why? Because think about it. Why would you put all these property taxes and homeowners insurance in escrow? You want those left in your account so that it reduces your mortgage balance until it comes to November, when you then write the check and pay the property taxes yourself. So we don't have to worry about escrows. So hope that answered your question. Great question. Thank you for asking that. Any other questions?
Yeah, this is Kathy. I've got a personal question. We've got a HELOC on my loan on our home. We got plenty in reserves for retirement and things like that. So something like that, we would just take this payoff. I'm just trying to figure out how I would transfer balances or pay it off or put this in place. Would you start out with a zero balance and just set it up for investing in another property, or could you kind of walk through a scenario like that?
Yeah. So let me just throw some numbers out. Like, so if it's someone who's in, they have it already. Let's say they have a first mortgage of 200,000. They have a HELOC of 50,000 right now, and the home's worth 500,000. So what we would do at that point, I'm just pulling out my calculator. So we would put in place, so if the home's worth 500,000, we would put in the maximum credit limit would be 400,000, but the initial draw at closing to pay off the first and the second would be 250,000. So at closing, yeah, the 250 would be drawn out, and then you would have available credit to you immediately of 150,000. I shouldn't say immediately. It takes about 20 to 30 days after you close to get your checks and be able to access the account. But does that answer the question, Kathy, on kind of how we would structure on a refinance if we were paying off a first and a second?
Yeah, kind of. I guess I'm thinking, is it worth then taking money you have in some stocks in a retirement fund to pay this off and get a zero balance and then use it, have that funds available to invest in another property? Do you see people moving money around like that? Is it wise?
Oh man, that's a great question on, is it better to draw from somewhere else to reduce the balance down? You would just, I don't know how to properly answer that other than I'm a huge fan of reducing the mortgage balances down because it saves you in the mortgage interest that you're paying. And money saved there is money earned, in my opinion. I feel like, I don't know. I personally pulled from other assets that were making returns to pay off mine when I did that. And I had another thought, something that I haven't covered yet, is this mortgage interest deductible? And the answer is yes, because when we report to the IRS, we don't tell them what type of a mortgage we have. It's just, we identify this as a first position mortgage, and the interest that you do pay on it, if you are itemizing, you can write this off as a deduction on there. But yeah, Kathy, that one I would involve a financial planner. And of course, they may want to keep the funds under their control, but yeah, it would be case by case, I would have to say on that one.
Okay, thanks so much. Appreciate it.
Yep. Great question. Okay. Any other questions?
Miles, this is Christy.
Hello.
How are you?
I'm doing great. Thanks.
You're awesome. Thanks for doing this. You and I had talked about this a while ago when we had met. I'd seen this strategy called velocity banking, but this has made it a lot easier for someone to do, based on through the bank and how you guys have it set up, how they have it set up. My question is the loan or the value that you're able to borrow based on the original loan amount or on the value of the home, the appraised value of the home?
Yeah, it's totally based on, they will do a new appraisal. So it's based on, appraised value. So if it's a purchase, they will go off of the lesser of the purchase price or appraised value. So I have one going right now where the guy's buying the home for $1,050,000. His appraisal came in at 1.2 million. Awesome for him. But they're going off of $1,050,000 and loaning him or setting his credit limit at 80% of that $1,050,000. On a refinance, obviously there's no purchase price, so they just do a new appraisal and will allow you to go up to 80% of the appraised value. If it's an investment property, you can only go up to 75%.
Thank you.
Cool. Great question. All righty. Any other questions? Those are great questions. If I didn't explain something really well, I think all of you guys know how to get a hold of me. let me know. I do have a video that I have recorded that is more directed towards clients. And so you're welcome to share that with your clients. And it gives also instructions on how they can use the simulator in looking at these things. I always tell people, when you watch that video, turn it on to like 1.25 or 1.5 play speed, and it makes it a heck of a lot better. It's 14 minutes long, so you can cut down the time. But let me know. I can send that out to you. Many times clients, well, I'll just say this. Wrapping your head around this sometimes is, you see people when the light bulb goes on. If you start selling them on a HELOC or a checking account or things like that, initially it's kind of tough to do. But if you present it to them as, this is a tool that can really help you reduce the years on your mortgage and can help you reduce the amount of mortgage interest that you're paying, that gets them thinking about the right mindset, and then we can present it to them. So anyways, thank you for taking some time to talk with me today. I'm available to you guys. You guys know how to get a hold of me if you have additional questions, or if you even think I may have a client where this could be a fit. Let's talk about it and see. We've had clients referred to us from Florida, all over the place, because they told me that I was the only one in the state of Utah doing this. I don't know if that's completely true or not, but it's a cool product and we hope to spread the word on it. So I wish you guys all a Merry Christmas. Thank you. We appreciate what you do. Yeah, have a great one, and we'll talk to you guys all soon.
Thank you, Miles.
Yep. Thank you.